So, all right, good afternoon from everywhere you might be hearing. All right, good afternoon, everyone from everywhere you might be hearing me right away. You are welcome to the November diet of your preparation for your examination with Next Gen Professional Associate. We are kickstarting right away, preparing you for you to write your exams in November. My name is Mr. Ebenezer, and I will be the one taking you through this journey. And I'm very much hopeful that as much as we're able to make a lot of person pass in the May diet, this November diet, as many that are joining us, I'm too convinced and confident that we are going to pass. Please, if you can hear me and you're ready for this class, just give me an high five, an emoji, just throw it up, and let's see. Okay, mute your mic, please. Okay. So quickly, in financial reporting, for those that are just joining for the first time, you will be well tested, and your questions in your exams is going to be 7 questions, and then you will be expected to attempt out of these 7 questions, 5 good questions, and this implies that you are only to attempt, you are not to answer the questions. That is the difference between accounting profession in terms of writing exams with other kinds of professions. You are only allowed to attempt, and the reason is we want to test your knowledge. If you have understood the basics that is required for we to call you a professional accountant. And like I always tell my students, if you are not qualified as a chartered accountant, you are just like a charge and bill lawyer, a lawyer that maybe the one that they have not called to bar. That's the kind of lawyer you have gone to school, but you are not yet, you have not yet been called to bar. That is the beauty of being a chartered accountant. So let's go straight forward to what we have. All that I need you to do is to have your notes and your biro and jot down as much as you can. When it's time for questions, I will, give the podium or the platform for us to ask our questions, and hopefully we will have the best of time together. I welcome you all specially, and I do hope that you're going to have the very best of time. Quickly, let's run to what we are going to look at, what we are going to be looking at in the FR class for this diet. The module is divided into 7. Adequojoluwa, Femi, Shola, please just hold on. I will call you when it's time for us to talk. I see you raising your hands. I wouldn't know why. I will call you when the time is due. So, like I was saying, we have 7 modules that you have to cover. It is so that you cover these 7 modules for you to sit for the exams. And I will be taking you through those 7 modules within the next 12, 13 weeks. And then hopefully we are too sure we will be grounded before we write our exams. So we have part A, we have module A, or part A as it were, and that talks about the conceptual and the regulatory framework for financial reporting. Conceptual and regulatory framework for financial reporting. And this is talking about, when we say framework, that is every of the guidelines that is required for you to know basically in order for you to prepare financial reporting. That is the module A. The module B, and that carries 10% of your total 100% of coverage that you are expected. So once you're able to cover module A, that means you have covered 10% of what you are expected to cover, and then certainly exams can come in from there when you are writing your exams. That is module A. Module A, conceptual and regulatory framework. You can be putting these things down to also guide us or to guide you in your preparation. So we have module A, and it talks about conceptual and regulatory framework. And then module B talks about the accounting standards and policy that is required for the preparations of transactions in the financial statement. In other words, we are talking about the standards. We have plenty of accounting standards. At your level, you are expected to know minimum of 28 standards and about 12 IFRS all put together. That's about 39 that you're meant to know. All of these put together, minimum you are supposed to be grounded with about 39 standards for you to be able to prepare quality financial statement. We will look at all of those standards in the Module B part of the FR lecture. Then we have the C part, the Module C, which talks about the preparation and presentation of financial statement. At your level, you're expected to look at a single entity general purpose financial statement. And that talks about how to prepare the financial statement of a single entity. That is the Module C. When we're talking about single entity, we are talking about an entity that does not belong to any group, a standalone entity. That is Module C, and that covers 20% of the 100% that you are meant to cover for your FR class. And then let me go back to Module B. Module B covers 15%. So the standards all put together, you need to know them, but you don't need to key yourself in knowing all. Why? Because it only carries 15% of the entire 100% that you need to be granted with for you to write these exams. I'm too sure that all of us, we can hear me wherever you are. It is if you can hear, just give me a thumbs up and then we'll move from there. Thank you so much. Okay, then let's move ahead. The Module D talks about the preparation and presentation of financial statement for simple group account. That is, group, an entity that belongs to the group. Preparation and presentation of financial statement for group entity. That is, two or more entity. And at your level, you are meant to look at a parent, a subsidiary, and an associate. So when you go to the professional level, you look at the complex one, as it were. And then the Module E talks about the analysis of financial statement, which is also known as ratio analysis. That also carries 15%. The preparation and presentation of a single entity financial statement carry 20%. The preparation and presentation of group account, that is what we know as group account, that is group entity, carries 20%. Ratio carry 15%. And then you have sustainability reporting framework. That is the Module F now, which is the 6th module. Talks about sustainability report framework. That one also carries 10%. And then you have the last one, which is Module G, the E part. And that is talking about the ethics, the current and technological development in financial reporting. So we have all of these 7 modules that we are going to look at under FR, and all of them put together, they carry their weight. We are expecting all of us to join in every time we have lectures. You'll be granted, and I promise you one thing: you are going to pass. Just relax yourself, let your mind be available, and then we'll look at all of these things together. Certainly, we are going to get it over with. Within the next 12, 13 weeks, you should be granted for you to write your exams. Like I said in the orientation class, for those that are there, MPS is the key way for you to pass your exam. That is, materials from next gen. Don't joke with them. Number 2, which is P, that is preparation. Please don't joke with preparation. Start early this way. Attend classes, ask questions, solve questions, pass questions, relate with people, get your understanding more enhanced. That is preparation. And then the third one is strategy. Strategy is key for you to pass ICANN exams. For instance, in this or all of this Module 7, a lot of persons usually concentrate in Module B and C and neglect the other 5 modules. And sometimes you only have one question coming from Module B, one question coming from Module C, and then you are spending the whole time, in dealing with standards, dealing with preparation of a single entity financial statement. You neglect the rest, and then exam will come, you get to the exam, or you won't be able to know how to answer. So it's said that you cover all of these modules, even if you are not going to cover each of the module 100%, but be granted at least up to 50%, so that when the question comes out from there, you can easily deal with it. I hope that suffices. So, Rosemary, you are raising your hand before we go properly into the question. Rosemary, you are raising your hand. AK and Nefiok, you are also raising your hand. Please, you can ask your questions as we proceed. You can go ahead and ask your question, please. Okay. No question, I guess.
It's one that to confirm the module is ratio analysis, and the module F. What is the module F?
The module F talks about sustainability strategy, as it were, that you need to also know. Are we together?
Sorry, I lost you. Sorry.
Okay, you said?
The module F. Can you come again, please? I could not hear what you were saying.
Yes, I said the module F talks about sustainability reporting strategy.
Module F. What does it condemn? Okay.
Sustainability report. We'll look at all of those ones. Is that taking?
No problem.
Okay. And then the F talked about the ethics and all those governance that you need to know. Okay, Abiodun, you are raising your hand. Okay, Doyin, go ahead, please. Are we together, please? Let's go ahead and ask our questions so that we can move quickly.
Please, if they are raising their hands, they should say something now so that we can move on.
All right, so let's close all the questions. Let's wait till later. We'll deal with all the questions. So quickly today, we begin with the conceptual framework, the conceptual and regulatory framework. That's what we'll look at in this class. And so the regulatory and the conceptual framework, deal with that. Please, every other question should be penned. When we are done, we'll deal with all of these issues together. Please, all of your questions, just keep writing them. Give me 1 minute, please. Okay. If you can see my screen, please just give me an emoji. Okay, thank you so much. So regulatory and then the conceptual framework, that's what we deal with. Like I told you, this is the module 1 of it. I'm very hopeful that we should be able to finish this today. And if we are done with it, it means you are done with 10% of 10% of whatever it is that you are meant to cover under FR. And I bet you the truth is there is no way a question will not come from this module. At least 1 or 2 questions usually will come from this module. So please, let's get prepared. And let's deal with all of this together. Frank, what is it?
I can't see the screen, sir.
Please, the screen is up. I'm sure a lot of persons are seeing it. Maybe it's your network. If you can see the screen, please just give me an emoji while we proceed. Okay, thank you. Please, let's go ahead. Okay. Sorry, please. I'm trying to work on the presentation so we can all see it together. Please ignore the noise that you are hearing from the background. Okay, please, let's move ahead. Oh, my screen, sorry. Okay, so let's move ahead, please. Conceptual framework. Let's begin with that. When we are talking about conceptual framework for financial reporting, what does it all imply? Thank you so much. It's up now. I'm sure you can see it. Conceptual framework, is more or less, when we say framework, it means that a policy, a guideline, what exactly, is guiding the way something should be run. It's like a theoretical system, an ideology as to how a particular system should work. That when we talk about that framework, that is the meaning of framework. So when we talk about conceptual framework, conceptual simply means that concept by which financial reporting and should be prepared. It is expected that accountants are to, help management to prepare their account as it were. And so therefore, if you are not guided adequately with principles, with all of these requirements, all of these required basics, you won't be able to prepare the account the way you are meant to prepare. So the conceptual framework, under financial reporting is more or less like, a system, a theoretical system that is issued by the IASB. And then, it guides how financial reports should be prepared, how they should be interpreted, and how it should be applied. You understand now? So that is all about a conceptual framework. You don't need the definition, just have the basic understanding. You understand now? If you are going to be asked in your questions, I will tell you the areas that you need to focus, not the definition, but just know that it is a statement. It is like a policy that was issued by International Accounting Standard Board. They issued it. The first one that was issued was in 1978, and then the revised one was in 2018. And all of this guides how accountants should, prepare themselves in terms of preparations of financial statement, interpretation of financial statement, as well as the application of financial statement. So it is a framework of policy put together that guide accountants world over as to how you are to prepare and present a financial statement. So understand that basic analogy that I've just made. So it is not in itself an accounting standard. It is not a standard. It is a policy guide. That is the difference between a standard. Apologies, please. That is the difference between a standard and policy, as it were. So understand this. We have accounting standards, and then we have what we call the policy framework. So the conceptual framework is like a policy guide to the standard. So it's not a standard in itself. It is not a standard in itself. It is what guides, the people that are setting the accounting standard, people that are preparing financial statement, auditors that are to, vouch the accounting statement, as well as every other users, as it were. So understand that when we talk about conceptual framework, it is like a policy guideline, as it were. So that being said, let's move ahead. What is the purpose? Very, very important. You need to write this down if you are not writing. The purpose of conceptual framework. What is the purpose or the importance? You can be asked in your exam. Number one, it is to help users of financial statement to interpret financial information appropriately. That is, it is to help the users of financial statement to interpret those information that are put in adequately. That is number one purpose or importance. Number two, it promotes what we call consistency and transparency in reporting. Now, if there is no framework that guides accountant world over, it means that if you are in UK, another person is in Nigeria, you can differ in the way and manner by which you prepare your financial statement, as it were. And then, users in UK may not be able to use the financial statement in Nigeria because they don't understand the modus operandi. So, it promotes what we call consistency. It gives you the chance to be consistent. What you did a firm did last year, if you're a new firm this year joining, it's easier for you to continue to do it the same way that firm is doing their own. The same thing applies to transparency. It makes everything to be open to the public. There is nothing to hide there. It's a statement for public consumption. That's what they call it, financial statement. It's a statement for public consumption, for them to make an informed decision. So understand that it gives you that drive. That is why conceptual framework is very, very important as an accountant. That's why we are beginning with it in terms of financial reporting. I'm sure you did not do financial reporting for those that are coming from the foundation class. You do what we call financial accounting. So reporting is different from accounting. When you are reporting, we know that you are a professional. You are dealing with the account the way a professional should do. So the first thing that you need to know is the framework, the policy that guides the way and manner by which you are to prepare and present the financial statement. So that is number two purpose. Number three purpose is that it also helps the people that are setting standard. It guides them as to how they should set the standard. It guides them, it gives them the guideline. These are what you check, these are what you should do, these are what you should not do. That is number three. Number four, it helps the auditor, to give what we call a good sense of judgment, forming our best judgment. In auditors now, they are the one that vouch financial statement, and it's just that they must give a report. So this conceptual framework also give them a guideline, holistic guideline, in forming the best of judgment, as it were. That is number four. And then you have all other importance, as it were. So even if you don't know all of them, just understand that it assists those that are setting the standard. That is the ISB, they are the one that are setting standard, will get there. They are the one that are setting it, assist them to know how to set it. Number two, it helps the auditor to form better judgment. Number three, it promotes what we call consistency and transparency. And number four, it helps users to interpret financial statements appropriately. Now, this conceptual framework, I'm sure you understand that now. As we proceed, understand it as this conceptual framework is divided into 8 chapters. 8 chapters altogether. Now, I keep telling you people that ICANN exam is all about strategy. Under this conceptual framework, you can be asked to tell us what are the importance of a conceptual framework. I've given you that. If I ask you the question at the end of this, you can't tell me, I will beat all of you. That's number one. Number two, you must know the chapters that is in this conceptual framework. Very, very important. You must know the chapters. And I said they are what? 8 chapters put together. So we are going to look at the 8 chapters. You can be asked to itemize the chapters. When I wrote my own FR then, I remember the question they said we should itemize all of the 8 chapters. And because I know it was seamless for me, I just itemized it. So you too, you should know it. So we have 8 chapters all together. Chapter 1 talks about the objective of general purpose financial statement. That is the object. You don't need to know all of this story. Just know that it is objective of financial reporting or financial statement. What is the purpose? Why are we preparing financial statement? And the primary objective of preparing financial report or financial statement is to help the users, to make an informed decision, quality economic decision. That is the summary. That is the summary. So the purpose is to provide information to every users of financial report, the people that want to use the financial report, for them to make what we call an informed economic decision. That also makes me to remember something now. In the marking scheme, somehow, I don't know, but that was what I heard, but I think it has been confirmed. When they are giving the marking scheme, when they ask you to define something, they will always, the marking scheme will say that once you see this word, mark the person right. If you do not see this word, mark this person 0. Now, what I have just said, I said, under the objective of general purpose financial statement, the objective is that it should give the users of financial reporting information to help them make economic and valuable decisions. Now, the word economic decision is very, very important and very, very key to any ICANN student. And the people that will be marking the exam and those that have set the question. And generally, you should know it, that the purpose of always preparing a financial report is to give adequate information to users for them to make an economic and valuable decision. That is the key thing first. All other things follow. And who are the users of this financial statement? We have the lenders, we have the creditors, we have the general public, we have the regulatory authority, even the management themselves, the board of directors, internal users, talks about the employees, the management, and the likes. That is the users of financial statements. So let's proceed this way so that it will give you a clearer picture. Who are the users of financial statement? They can be divided into two. We have the external users and the internal users. Why I'm bringing this up now is that you can be asked in your exam to mention the internal and the external users. Please write down now. We have the internal and the external users. The external users, they remains the general public, the creditors, the lenders. Let me come again. General public, lenders, creditors, the regulatory bodies like tax authority, all these pension, CBN, all of them like that. They can use it. So those are the major external users. And then we have the internal users of financial report of an entity. The internal users are the likes of the employees. They can use it to assess if the company is going down or is going up. That is talking about the going concern of the entity. They can use it to test it. That is the employees. We have the management of the company. The management of the company can use the financial report to make decisions for the future. Very, very important, and you should know that. And then we have number 3, to include the boards of director. The boards of director or those charged with governance. All of these people put together are what we refer to as the internal and the external users of financial statement. The materials are available. Don't bother yourself, just jot whatever it is that I'm telling. That is the key thing that you need to know. But the materials, you must also buy them so that you can refresh your brain, make your own jotting, prepare yourself adequately. It will be available just immediately after this class. So let's go ahead. That is everything that you need to know in chapter 1 as it were. You have any questions, please jot them down. We have our questions immediately after this class. So let's go to chapter 2. Chapter 2 talks about the qualitative characteristics of a useful financial information in the financial statement. Now, what this implies, if we agree that the usefulness of any financial report is to give information to users to make an economic decision, what are the qualities that those informations must have? That is what the chapter 2 of this framework is talking about. Chapter 2 talks about the general quality, the quality or the qualitative characteristics of a useful financial information. They can be divided into 2 characteristics. We have what we call the fundamental characteristic, and we have what we call the enhancing characteristics. Fundamental means germane, very solid, very, very important. That is the fundamental characteristics. And then we have what we call the enhancing characteristics. That is what enhances the fundamental characteristics. And so we have what we call, under fundamental characteristics, we have what we call relevance. We have what we call relevance. Relevance in this instance implies that any information you are presenting in the financial report must be relevant for economic decision making. For instance, you cannot use last year inflation to make decision for this year inflation. As well, you cannot use the interest rate that was used last year to make a quality and informed decision in this current year. Why? Because there have been changes. There has been a lot of changes over time. That is why information you are providing in the financial report must be relevant for decision making. That is number one under fundamental characteristics. And then the second one is faithful representation. In other words, every information you are providing on the financial statement must be complete. It must be void of bias. It must be free from error. It must be transparent. It must be faithfully represented. You are presenting that information as the way it is, not as the way it ought to be, the way exactly it is. You won't call 2 1 when you are meant to call it 2. You won't call 3 4 when you are meant to call it 3. That is the simple analogy to it. As I'm talking now, just be reminiscing. Let it be entering you in case you just maybe you don't have time to read. You will be remembering in the exam that I said something like that. So we have faithful representation. That is, it must be complete, void of any material error, and then it must be neutral, void of any kind of bias. You don't prepare account with bias. That is the fundamental characteristics. Then you have the next one, which is called the enhancing characteristics. Enhancing characteristics. Under this enhancing characteristics, you have basically 3 of them. 3 major enhancing characteristics. 4, sorry. 4 of them. So you have what we call comparability. Any information that you are giving in the financial statement must be useful for comparison. I must be able to compare company A with company B. I must be able to, well, as long as they are in the same industry. It is important for me as user of your financial statement to be able to compare the figures of your last year with the current year. And that is why we say that every form of financial information you are presenting must be, adequate and useful for comparison and purpose. That is number one. Number 2, verifiability, meaning that every information you are providing is verifiable. Like an auditor, what they do is to verify whatever it is that you have put down. We must be able to verify it and ascertain that you have materially, impute the information in the financial report with utmost good faith. Number 3, timeliness. That this information is available to users on a timely basis. In other words, the information that are meant for July, you don't keep it for July 2025. You don't keep it till July 2026. It must be timely. It must be available on the spot. Quality for us to make a quality decision as it were. So that is that for that. And then understandability. In other words, it is expected and expedient for any user of financial to understand what you have put down in your financial report. You don't make it ambiguous. Make it as transparent, as quality as it should be. Those are the qualitative characteristics. So before we move ahead, let me ask my first questions before anyone will go ahead to ask me a question. My number 1 question is this: who can give me definition of relevance? Definition of relevance. Anybody, just raise your hand. Okay, Oluwakemi, go ahead. Oluwakemi, you are raising your hand. Go ahead. Okay, Ishaku Ibrahim, you can go ahead, please. Can you all hear me? If you can hear me, give me an input.
Yes, I can hear you, sir. Yes, I can hear you, sir.
Samuel is man.
Okay, can you hear me, sir?
Yes.
Okay, so to be relevant in this context is for the information to actually be valuable at the current state of what is needed for. The information might be okay, but is it valuable or is it useful for the current situation at which you want to use the information for?
Thank you so much. You have just hit the nail. So let's go on. I will give you 2 marks for your question now. Please be claiming the mark I'm giving you. That was how I was giving them mark the last time. All the people I gave mark, they have all passed effort. Be claiming it. I'm giving you 2 marks somewhere because you have answered my first question. Thank you so much.
I claim it, sir.
Claim it too.
I claim it.
Thank you so much. Now, before we proceed, don't worry, I will ask my question. I always have acronym for these characteristics, qualitative characteristics of financial reports. I have what I call the acronym. Now, this acronym guides a lot of students that they won't forget it in exam hall. And what is the acronym? The acronym is what I call FR, that is Father V Court. Sorry for apologies for all those people that might think that I'm using father for another thing. I mean father. I didn't say father. Father V Court. Father V Court. FR stand for father. If you cannot use father, you can use financial reporting. But don't use financial reporting because it might go to exam. You go there and go and write financial reporting. F stand for faithful representation. R stand for relevance. V stand for verifiability. C stand for comparability. U stand for understandability. T stand for timeliness. So you cannot forget it, because if they are going to ask you a question on that qualitative characteristics, they will tell you to, mention. They may say, mention the qualitative characteristics of a useful financial report. Just remember what I said. Father V Court. Father V Court. F stand for faithful representation. R stand for relevance. V stand for verifiability. C stand for comparability. U stand for understandability. T stand for timeliness. And when they ask you this question in exam, once you write F, know that it's a faithful representation. Put column. Always itemize them. You see, when you itemize this thing, that is when your mark will come. For instance, they say you should give us the qualitative characteristics, and you just put FRV Court there. That is 1, 2, 3, 4, 5, 6. There is no way, if the question is 10 marks, when you put faithful representation, you put column, you explain in the front of it. There is no way you won't have up to 8 or 9 out of the mark. And then you are looking for how many to pass your exam? Maybe 40. Put these things inside your pocket. That is the strategy we are talking about. Is that okay? Thank you so much. Give me an emoji if you understand that. Father V Court, that is the characteristics. And then for the usefulness of financial, the chapter 1 that we look at, the general purpose financial statement, why do we use it? I told you it is to help the users, to make an informed and economic decision. Just on that one. Then under that chapter 1, they can ask you, who are the users of a financial statement? I told you we have external and we have internal. So mention those that are under external, mention those that are under internal. That is that for that. So quickly, let's move ahead. I'm sure you don't have questions. This thing is well assimilated. So we move ahead to chapter 3. Chapter 3 talks about the reporting entity, the financial statement and the reporting entity. You don't need to put the financial. Just know that chapter 3 talks about reporting entity. Who are the reporting entity? Reporting entity are those that prepare financial statements. As simple as that. Don't know anything more than that. Reporting entity are those that prepare financial statement, that prepare financial report. It can be single, it can be double. Single means you are not into any group. Double means you are into group. So we can have it as a single entity or double or grouped entity. Is that taken? That is that for chapter 3. Then we move quickly to chapter 4. You don't need to bother yourself. I'm giving you what is required as you should know. The material available for you. Just take it and enjoy yourself for a refresher. So we have chapter 4 And this is the basic, the key thing that you must know as a professional. You must know them. Chapter 4 talks about the element of a financial statement. So we have 5 key elements of financial statement. Who can mention them? If you mention them, I'm going to give you something. Elements of financial statement. Oh yeah, Michael, go ahead.
Yes, sir.
All right, sir. The elements of financial statements include statement of financial position, statement of profit and loss, and cash flow statements, statement of equity, the remaining 2. Income.
Frank.
The elements of financial statement. Yes, sir.
Go ahead.
Elements of financial statement include the assets, the liabilities, expenses, and equity.
Okay. Now, before I will judge, let's go and check it if they are right. The 2 of them, which one is right? And then you will now know. Let's go ahead. Element of financial statements. Let's go. Chapter 4. The element of financial statement are mentioned as follows. So, Michael, you can see that you are half wrong and half right. I won't say you are wrong because, you are a professional. And as a professional, you can be right. Everybody is entitled to his own opinion. We can't tell you are wrong. Is that okay? So, these are the key elements. Now, class, understand this. Don't get it wrong. We have what we call the component of financial statement, and we have what we call the element of financial statement. The element of financial statements are the assets. There are 5. Assets, liability, equity, income, and expenses. That is element. Elements. When they say element, that is why we call it element. Elementary. The elementary of a financial statement. Don't forget, I know why I'm saying this. Somebody went for an interview and he was asked what are the elements of financial statement, and he was mentioning the component. That was how, just like what Michael did in his answer. Do you understand now? The next chapter, which is chapter 5, talks about the component of financial statement. Do you understand now? So this is the element of financial statement. The asset. Assets are the resources that are being controlled by an entity due to their past events. Please understand that. Liability, they are the present obligation of an entity arising from their past events, as it were, past activity. When we talk about asset, we are talking about the resources that an entity is controlling. You have over 50% control over. That's what we call an asset. It can be what you have control over within a year or more than a year. That's why we have what we call the current asset and the non-current asset. The current asset is what you have control over within a year. The non-current asset are the ones you have control over more than 1 year. You also have liabilities. Liabilities, they are your obligations. The obligation that a claim is laid against from your asset. You understand me now? The obligation that you must pay back is so that you pay them back, and then you are generating the payback from the use of your assets. It is your asset that you use to generate what we call revenue. It is from your asset that you also, derive what we call the expenses, as it were. So we have also equity. Equity is the residual interest, in the asset after deducting the liability. In other words, it is what is due to the owners of the business after all other obligations have been taken care of. What is due to them? That is what we call equity. Whereas income, they are what you derive from the economic usage of your economic assets, your economic resources. When you continue to use your economic resources, what you derive from it is known as income. Whereas expenses, they are what you are meant or you are obligated to offset in order for you to generate what we call income, as it were. So these elements are structured into the financial statements. You understand? These elements that you are seeing, they are structured into what we call the components of the financial statement. For instance, the asset, the liability, and the equity, they are structured into the statement of financial position, whereas the income and expense is structured into the what we call the statement of profit or loss and other comprehensive income known as super as it was. So that is chapter 4, chapter 3. So quickly let's go to that's chapter 4, sorry. And then we have, I think I've missed one. Element of financial statement. Okay. Under chapter 3, chapter 4. Okay. Now let's go ahead and talk about I've missed them all, but just understand it that the next chapter is a component of financial statement, and that talks about the what is it called now? The statement of financial position, statement of profit or loss, statement of changes in equity, statement of cash flow, and then the statement of policy. Me, I call it statement of policies. Why? Because it is known as why others they know it as a notes to accounts. Statement of financial position, statement of profit or loss, another comprehensive income, statement of changes in equity, statement of cash flow, and the statement of policy, which is also known as notes to account. That's a component of a financial report or financial statement that you can be asked. Please note it. It's very, very important. Now, let's go to the next chapter, which is chapter 5 of chapter 6, as it were. And that talks about recognition and derecognition. When we talk about recognition and derecognition, what we're simply saying is, for you to recognize an item on the financial statement, there are certain things that are very, very important. And what is that thing? For you, the simple definition of this recognition is that for you to recognize an item on the financial statement, it must meet with the criteria. And what is the criteria? That is the definition of that items under its elements. Let me come again. For you to recognize an item in the financial statement, it is very, very important that they meet with the criteria. Number one criteria is the definition of that item according to its elements, as explained earlier, according to the elements of the financial statement. In other words, if it is an asset, it must meet the definition of an asset for you to categorize or structure that item under asset or in the state of financial position, as it were. If it is a liability, it must meet with the definition of liability for you to recognize it in the financial statement. And then when we are not talking about the recognition simply means that that item is no longer meeting the definition, and so it must be expunged. It must be removed from the financial statement. A good example is a fully depreciated asset. When an asset is fully depreciated, it means that it does not meet then the definition of an asset again. Because the definition of an asset is that you have control over it and you are using it to generate future economic benefit. So if an asset that is fully depreciated is no longer generating future economic benefit to the entity, it can no longer be recognized as an asset, so you have to derecognize it. Another example is when we get to what we call IFRS 5 now, where we talk about asset held for sale. Now, an asset that is held for sale, it has a non-current asset before now. A very good example is motor vehicle. You have been using your motor vehicle. It has maybe 3 or 4 more years in your books, as it were. But then you decided that this vehicle is not serving me the way I want it to serve me. What you do is you reclassify it. Once you reclassify that asset, it will no longer have what we call the value of a non-current asset, but rather it will be reclassified into a current asset. Why? Because you have already determined that you are going to sell the asset. And one of the criteria is that you will sell the asset within 1 year. Let me not bore you. When we get to IFRS 5, you will understand better. So the simple meaning is that recognition means that you must meet certain criteria for you to classify an item as an item in the component of a financial statement. While the recognition simply means those items are being removed. They are being taken away from the financial report. Why? Because they are no longer meeting the definition or the requirement as it were. Is that taken? Are we together?
Yes, sir.
Thank you so much. So let's go to the next chapter. The next chapter talks about measurement. Measurement simply means how to do the calculation. That's how I will always tell you. When they say measurement, please note this very well. It's very, very important. If you know this now, you won't have problem again. Measurement simply means how to calculate the figure you are going to attach to the item in the financial statement. If you have called it an asset, you can't just call motor vehicle. What is the value of motor vehicle? How do you calculate it? That is what we call measurement. So measurement can be, that is, calculation of a value that you will attach to an asset can be, the use of what we call the historical cost. That is, the cost at which you acquire the asset. That is what we call a historical cost. Or the current cost. The current cost simply means when you revalue the asset. You understand? For instance, you buy motor vehicle this year for 2 million naira. Let's say you bought the vehicle last year for 2 million naira. Now, in this year financial statement, you now want to know what exactly has even happened. This car, this Corolla that I bought for 2 million naira, how much are they selling it now? You now went to the market, you discover that it is now being sold for 3 million. It is expedient that you don't carry your asset or items in your financial statement at a lower or lesser value. It must always be at the current value. So therefore, you can attach value to that your items in the financial statement, using historical cost or the current cost. That is, you know what exactly is the state or the cost of the asset as at today. When we also proceed to IAS 16, you will know how to appropriate this when we do revaluation. We do revaluation on IAS 16. And then under IFRS 13, we talk about the fair value. We also discuss it more far better. Under IFRS 5, we're also going to discuss some of these costs as it were. But when we talk about measurement, the simple meaning is that how to calculate the value of cost that you will attach to the item as it were. I don't like talking too many accounting terms. I like to talk like a layman so that you will understand it better, assimilate it, take it in, and then you will not forget. When you get to exam or in a real life situation, you will always know how to answer the question, because now you are tending to become a chartered accountant, and they believe in this general society that every chartered accountant knows everything. So please be knowing it as I'm talking to you. And then next chapter talks about presentation and disclosure. That is to say, how you are to structure and organize the information in the financial statement, that is presentation. How you are to structure and organize the financial information in the financial statement, that is presentation. While disclosures is simply talking about the explanatory notes, the notes of the account, the notes that you're giving, for those items. Why did you carry this item? What are the justifications? What are the policies you use? What are the standards you apply? What are the calculation method that you use, the measurement measure that you use? That's what we call disclosure. That is in chapter 7, as it were. Now, I want to take you back to what we call, I want to take you back to chapter 4. Under chapter 4, we have two, I just remember it now. Chapter 4 has two major sides. We have what we call the element and the component of a financial statement. Please, that is chapter 4. Chapter 4, element and component of a financial statement. The element talks about the natures. That is talking about the natures of what we call the components. The nature of the components. And we have the asset, liability, equity, expense, and the income. Why the component talks about the structure of the financial statement. So we have statement of financial position, statement of income, statement of profit or loss, another comprehensive income, so forth, and then you have a statement of cash flow, statement of changes in equity, and statement of policy known as notes to account. Please take note of that. Very, very important. Chapter 7, we have dealt with that. Now we go to chapter 8. This chapter 8, very, very important for you to know. And I don't want to rush it for any reason. Chapter 8 talks about concept of capital and capital maintenance. Now, before we discuss this concept of capital and capital maintenance, under this conceptual framework that we have looked at so far, from the importance to the 8 chapters, 3 basic questions that they can ask you. Please note it now. Number 1, you can be asked to itemize the 8 chapters and give little explanation. You can be asked to itemize and explain the 8 chapters put together. That is 1. 2, you can be asked that what are the usefulness of a financial statement, usefulness of financial report, or they can ask to hit who are the users of financial report. That is that. Then they can ask you, number 3 now, they can ask you, what are the qualitative characteristics of a good financial report? Qualitative characteristics of financial report. Very, very important. That is number 3. Number 4, they can ask you, what are the concepts of capital and capital maintenance? I'm only telling you under this conceptual framework where your questions can come from. So if you know this very well, I think you are good to go. That if they bring any question, you can deal with them. Is that taken? If that is taken, just give me an emoji that you have understood what I'm saying. Thank you.
Sorry, sir. Concept and what?
Concept of capital and capital maintenance. Titila, what did he say?
Okay, I just want to be clear of what you said. I just want to be clear of what you said. Thank you very much.
Thank you. All right, thank you so much. So that is that for that. So let's go to this concept of capital and capital maintenance. You see, every business have what we call capital. In fact, there is no business that sustained without capital. So when we're talking about capital and capital maintenance, we are talking about a principle whereby a business or an entity maintains its capital, before you declare your profit. Now, let me break it down in a layman way. You bring in 20,000 naira into the business. It is expected that before now you have, you use the 20,000 to do business and do business for a whole year, the year 2024 and 2025 as it were, January to December. Use that 20,000 to trade. Now, in the year, December, on 31st of December 2024, all of the money that you have, after removing your expense and everything, you now have 25,000 naira. Now, you cannot call that 25,000 naira your profit. It is expected that since you started the year with 20,000 naira, first of all, you will remove that 20,000 naira as your capital. You must maintain that capital. Then the 5,000 is not known as your profit. So when we are talking about concept of capital and capital, it means that every entity must always ensure that they maintain their capital threshold every year in and out before you can declare or assume that you have made profit. That is what we call concept of capital and capital maintenance. So capital means what you employ in the business. Capital maintenance means maintaining the threshold. It's as simple as that. Is that taken? Capital means what you have employed into the business. Capital maintenance means maintaining the threshold year in, year out. Is that taken? Thank you so much. I'm sure it is taken. Now, under the concept of capital, we have what we call financial capital. Financial capital. Financial capital, they are what we call, those money. Let me just say it. Financial capital means money. Ego, kudi, owo. I don't know other languages. If you have your language, just put your own. So financial capital means money. That is that for that. So it is expected that your profit is earned only after you have been able to put in place your financial capital. Because the truth is this: every business will always begin with money, ego. There is no business you start with your energy. let me just use it that way. Energy, by the way, there's one business that you start with using maybe your building. You must always use your money. You use money to start the business. So financial IFRS, for instance, they believe in the use of what we call financial, reporting, the financial capital. So it is widely expected that you must use it that way. Then we have what we call the physical capital. Under the physical capital, we are talking about the fact that your operating activity put together must, how will I put it that you will understand now? When we're talking about the physical capital now, it means that when you are operating, your operations, you are operating, turning over your capital, it is important that you must ensure that whatever it is that you have imputed as capital, you have employed into the business as capital into the business, you must maintain it strategically, consistently, notwithstanding how you have operated. Now, in a simple way, it means that you are turning over your capital, you are turning it over. Don't lose sight of the capital for any reason. Ensure that that capital remains steady. You don't touch it, you don't draw from it. You maintain it as it were at the beginning, you maintain it as at the end of the close of the financial year. Now, I don't want us to really, how will I put it now, to rush this too well, but understand the basics now. And then when we look at questions, I believe you have more answers and more insight, as it were. So now that is that for that. So capital maintenance, as it were, I think I've been able to explain it and explain it. So let's go to questions, because I have this past question that I want us to look into. When we look at it very well, you will now have the understanding of this concept of capital and capital maintenance. Please let me recap before we look at this question. Concept of capital and capital maintenance, talks about your capital, what you employ in the business, and then the capital maintenance talks about maintaining threshold year in, year out. There are two types of concept of capital and capital maintenance. We have the financial capital and capital maintenance, and then you have the physical capital maintenance. You understand? The financial is what I just told you. That one has to do with money. Means that your money, the money that you have employed in the business at the beginning, you must always be able to account for it at the end of the day. The same thing with the physical capital. So let's look at this question together. It said, discuss the significance of the concept of capital maintenance in financial reporting. Distinguish clearly between financial capital maintenance and physical capital maintenance, highlighting their implication for profit measurement and reporting under IFRS. This is an ACCA question. And any question they want to ask, if it is a theoretical question under concept of capital and capital maintenance, cannot be more than this. I have provided the answer for you so that you can have the basic understanding. Now, when we talk of capital maintenance, or what I will do is, for those that buy the material, they are the one that is supposed to even enjoy this question. But let me just give you this one. So when we talk about capital maintenance, it is a concept in financial reporting that influences how profit is recognized. I've explained that. It ensures that an entity capital base is preserved before any return is distributed as profit. I've also explained that. In essence, profit arises only after the capital of an entity has been maintained or recovered. Types of capital maintenance are financial capital maintenance. What is financial capital maintenance? Financial capital maintenance is, it's all about you recognizing profit when the amount of the net asset at the end of a period exceeds the net asset at the beginning of the period, after excluding distribution to and contribution from the owners. Now, what this is saying is this. Financial capital maintenance. They also do the calculation. Let me just explain it in this context now. How do you do the calculation? You check your assets, your net asset at the beginning of your financial year. Understand this. When we're talking about your asset, it means your current and your non-current asset, all of them put together. Check it at the beginning of the year. What is the net? What is the net? And how do you determine your net asset? Your net asset is your total asset, which is your current asset plus your non-current asset minus total liability. It will give you what we call your net asset. Do you get it now? So your net asset at the beginning, when you have it, you now compare with the one you are closing with at the end of the year. Your net asset at the end of the year. If your net asset at the end of the year is higher, the difference is what you can now call profit, as it were. I hope you understand that. Your net asset at the end of the period exceed the net asset at the beginning of the period, excluding distribution to and contribution from the owner. In other words, if you are distributing any dividend, as it were, you are going to remove it. If there is any additional money from the owners of the business, you are going to remove it. So those ones are not considered. Now let's look at this example together. I must pass ICANN PLC now. Please write it down, because you are going to be the one to do the calculation for me. I must pass ICANN PLC at the beginning of the year as a total current asset of 30. Put it down. And a non-current asset of 100 at the beginning of the year. Put that down. Full stop. At the end of the financial year, 2 naira was distributed to the owners of the business. 2 naira was distributed to the owners of the business. And the total net asset for the year is 200. Let me come again. I must pass ICANN PLC as at the beginning of the year current asset. Who can tell me what the current asset is?
30.
Thank you. And the non-current asset is
500. 100.
It's 100. That is that for that. I said full stop. At the end of the year, 2 naira was given as dividend to the owners of the business. And the net current asset at the end of the year is estimated to be
200.
200. It's estimated to be 200. Determine A. The profit for the year. Or no, let's reverse it. Determine A. The capital threshold for the year. B. The profit for the year. So before we answer that question, Rosemary, you have been raising your hand since. Let me attend to you. Rosemary is Yehi. Okay, let's go ahead. In giving your answer, the first thing that you must identify is what is the net asset at the beginning of the year.
Sorry, sir.
Go ahead.
Please, I can't hear the question. I must have pass ICANN PSS at the beginning of the year. Current assets of, is it 30 naira or 30 million?
30
and I didn't get the rest of the question.
30
okay,
naira,
sir. Okay.
30 naira and then 100 naira Non-current assets.
Okay, no current assets. Okay, sir.
100. At the end of the year,
Yes, sir.
at the end of the year, they gave 2 naira as dividend to the owners. And then the total non-current assets at the end of the year is 200. Require. Determine the capital threshold. A, determine the capital threshold. Determine the capital threshold.
So, sorry, sir. The total non-current asset is how much, sir? It's breaks. I can't hear you.
The total non-current
At the end of the year.
asset is 200 at the end of the year.
200, sir.
Please give me 1 minute and come.
Yes, sir.
Please, I don't know if anyone get the first question he said earlier.
Okay, so the first question is determine the capital threshold for the year. Determine the capital threshold for the year.
Capital threshold.
Yes, threshold for the year.
First question is
For the year?
Yeah, that's the first one. The A, determine the capital threshold for the year. Then I think the second one is the B is determine the profit for the year. But I also want to get it clearly. But I think that was what I heard because he was trying to make profit.
Determine the profit for the year.
Okay.
And then the profit for the year. That is the capital that must maintain. That's what I mean by capital threshold. The capital that must be maintained.
Determine the profit for the year.
Profit and capital for the year. Thank you. Can anyone give me the answer? So the first thing first for you to do is this. Determine what is the capital threshold at the beginning of the year. What is the capital threshold at the beginning of the year?
Hello, sir.
Yes, sir.
Can I try? I just want to attempt the question.
Please go ahead. Go ahead.
The threshold is 130, while the profit is 70.
Okay, you have tried. Any other person that can try? You have tried. You got the main part very correct.
Hello, sir.
Yes, go ahead.
Okay, the capital threshold, I just want to try. Capital threshold for the year is 130, while the profit is 68.
Let me clap for Adepoju. Let me clap for him. I'm giving you two. Now, my brother that tried the first time, what you missed out was, I told you, when there is anything like dividend, you don't recognize, you remove it. You adjust it. That's what we call adjustment. You adjust for it. And if there is any money that was given...
Oh, sorry, sir. I missed that dividend statement. I think my network was freezing, so I couldn't hear the aspect of that dividend.
All right. So that's not testing.
Thank you, sir. Thank you, sir.
So that is that for that. So now that is how to determine it. And like that. So let's go to a question that has...
Sorry, how did you get 68, sir, as the profit of the year?
You said?
How did you get to 68 for the profit of the year?
I told you.
To take away the dividends from the profit.
How do you determine the profit? So let's go. Please also don't know how we can close it. The profits you did. How do you determine it? Number one, the steps are you determine the capital threshold that must be at the end of the year. In other words, your capital threshold at the beginning, that is your capital that you have at the beginning, the capital that you must maintain that you have at the beginning, must be maintained at the end. Remember, at the beginning, our total was 130. Is that also? And at the end, it's 200. Is that also? If you take, I told you, if there are no dividend that was paid, or money that is received from the owners of the business, which you are going to net off, you just remove the beginning from the closing, and that will give you your profit for the year. In this instance, we have a dividend that was paid to the owners of the business. So we have the threshold to be 130, at the beginning. At the end, we must maintain that 130, which is what we were given. So we remove the 130 from the 200. Then we have what we call total will now be 70. But we pay dividend. So you remove. Oh God, I've even made a mistake. We are not supposed to remove the dividend. You are supposed to add. Please don't remove the dividend.
That is what is confusing me. That is why.
You can't remove the dividend. The answer should be 70. You ignore the dividend, please. Thank you so much.
Sorry, sir. Why are we not removing the dividend? Dividend is money for the shareholders.
Dividend is part of the profit. They ask us to calculate the profit. They ask us to calculate the profit, and dividend is the part of the profit. It's part of the profit. So that's why they said after deducting the profit, what will be the net profit? That is when we are going to have 68. But they ask what is the profit?
Sorry, sir. According to the definition, which I understand is this capital maintenance, the profit is recognized only when the financial amount of net asset at the end of the period exceeds the net assets at the beginning of the period, after excluding distribution to. And distribution to, I don't know if we can recognize the dividend coming in.
No, that's why they say after excluding. Hold on. That's why they say after excluding. Hold on.
Sorry, sir. Okay.
In other words,
let him
when they
talk
say
now.
after
Let
excluding, in other words, it means you
talk.
are not going to recognize. You are not to recognize that dividend that was paid to the owners. Now, assuming that they gave us in this question assuming they give us another amount that was being given
preference share
by the shareholder.
Preference shares.
Assuming now there was maybe an additional form by the shareholder now, we are not going to recognize, we are going to remove it. You understand? But for dividend that was paid, you have to ignore it.
It's because it's part of the profit already.
It's part of the profit. It's part of the profit, so you cannot lean it off. Is that
okay? So, sir, can I say something for a bit clarity to say?
Go ahead.
Okay, so I think for dividend, actually dividend is being paid out of profit. So if we are trying to recognize the profit, definitely we need to come to terms that we've gotten the profit before dividend goes out of profit. So if we have a dividend, we are not taking it out because dividend is inclusive in the profit we've made. So if we had an expense, that's where we can now say, okay, we are trying to take it out to come to conclusion of what we have as a profit. But dividend is actually part of the profit that will be distributed later on.
That is how it is.
So sorry, sir. I think to me, you can't declare. You are declaring dividend on the profit. So dividend and still come and say you have profit. Dividend is not an expenses. So because of that, dividend is part of the profit. So it's only when you know the profit, you are declaring dividend on profit. So you have firstly ascertain the profit before you talk of dividend. So that's why you are not taking away the dividend from the profit. So that's why you have 200 minus 130, making it 70.
Thank you so much. All of you have passed. If you have this understanding like
Amen.
this, you are ready. FR is a walkover for you. Clap for yourselves. All everybody, please clap for yourself. You have done well. So understand it. It's as simple as that. It's as simple as that. Ignore dividend. Always ignore dividend. Dividend. I put that dividend to confuse you, and then it has confused you. Donatus, you are ready.
I'm sorry, sir. I thought the word this was distribution, not.
You said? Go ahead, please. Donatus, please go ahead.
Hello, sir. Hello, sir.
Go ahead, I can hear you.
Please, I just want to get a clarity on a particular statement under the asset, the definition of asset. You know, the asset is being defined as a resource controlled by an entity as a result of past events. So I just want to understand what do they mean by that past event in that definition.
Hold on. That past event means that you are turning over that economic resources. That is, you are using that economic resources to generate what we call future economic benefits. If you have a motor vehicle in your business and you park it, you are not using it, that you cannot consider it as an asset. Why? Because you are not turning it over. That's why they say an asset is, an item that an entity has control over and is being used in the course of the business to generate future economic benefit.
Thank you, sir.
So the process of you turning over your asset is known as a past event. Is known as events. As event is coming, one is coming, the other one is going. So the key traits under assets, number one is ownership and control. Ownership, you must own it, and for you to own it or have control over the asset, you must have more than that. The control must be that more than 50%. You have control over 50% and above. That's what we call ownership or control. The entity must have the right to use the item at any point in time. Not that you want to use, somebody will say no, you cannot use it. No. And number two, that asset must be used to generate future economic benefit. It's not that you have the asset, you acquire the asset and you keep it. Do you understand me now?
Yes, sir. Thank you, sir.
Sorry, sir. Yeah, I have a question. Sorry. The chapter 5 on the recognition. Yeah. So I'm a bit unsure, or that's why I'm trying to raise the question. So the concept of measurement, does it really pertain to just the asset or liability of the company, or it encompasses on all the elements of the financial reporting?
Yes, all the elements.
Okay.
I just use
because
I
asked,
an example.
Yeah, okay. Because you used assets. That was I'm asking. I'm a bit unsure if it encompasses on all the elements.
Historical cost, for instance, historical cost has to do is the first cost that you will even attach to every items that you structure under the elements of financial statements. The historical cost. What is historical cost? The cost at which
you have been using
identify an asset. It's as simple as that.
Yeah.
If you go to an asset to buy Maggi, to go to the market to buy Maggi, that price that you buy the Maggi is known as the historical cost. That is the first cost that you will recognize in your financial statement. You understand now? It is the same thing with equity now. Take for instance, the money that the owner of the business contributed to the business, that is the historical cost of that equity. Do you understand it now? Liability too, for instance, now you went to bank to borrow money, they borrow you 50,000. That is the historical cost of that liability. Is that taken now? I only use assets as an example. Any other question, please? Adebayo, please go ahead. Adebayo, Debbie.
I did not get the past question. The question you said on ACCA past question on discuss the significance or something. I didn't get the question.
Get the material is there. Get the material, it is there. All our material put together is just once you pay 3,000, every material will be given to you. That's all. It's not something that 3,000 is more money now. Get the material. Plenty questions are in this material that when you go through them, you enjoy yourself. There's nowhere we said a question that I've not put the question there. And once you can see there, you just deal with them.
Hello, sir. Hello, sir. Regarding to that materials, for instance, for FR, does it contain all the topics relating to FR?
Yes.
Okay.
From beginning to the end. That's why I said we've just been giving it in piecemeal like this. Once we are done with this class, Conceptual Framework is ready. We'll deploy for those who have made the payments, and then you can run through it. Even this weekend, just sit with it. Just, you see, the best way to handle ICANN is have your own summarized note somewhere. You understand? Practice
Yes, sir.
past
How do
questions. Don't worry.
How do we
Once
make
we're done with
payments
the
for
class now, every of those information will be posted on the platform. You can see anything you need.
It's on platform. It's on platform. How to make payment is on the platform.
Okay.
But Mr. Peters, please, I would like to get your number, sir.
Okay. No problem, sir.
Thank you, sir.
Okay, sir. Quickly, I have a question, sir.
Go ahead, please.
Okay, so for the chapter 4, does the elements of financial statement and components are under chapter 4?
Yes, that's what I said. They are under chapter 4.
Okay, so chapter 5 is recognition and derecognition. Yes. Chapter 6 is measurements. Chapter 7, presentation and disclosure. Chapter 8, concept of capital and capital maintenance.
Yes. Please,
all right, thank you, sir.
Know this chapter. I'm begging you people. It's been a while they set question that you should itemize. They may bring you this diet. And you know, November diet used to be theoretical, more theoretical. You will write and tire.
Okay.
And once they bring theory for you, just so that you have passed. Theory is very simple because nobody is going to read all the story you are writing. The key point is what they need. And that's why you must always write something. You know, I always tell you this. Anytime you are in the exam or you have to write exam, don't leave your paper blank. They say attempt 5 questions. Make sure you attempt 5. Even if it's A that you know in 1, you don't know the B, C, D. Doesn't matter. Attempt is attempt. That is the first thing, no.
And again, sir, how do we go back to those to the lesson if we eventually miss the class?
It will be we are recording it and it will be uploaded.
Okay.
Yes, on our YouTube
Thank you, sir.
Please, sir, can we continue?
We can continue. So let's look at this question and then we close the class. Now, a company acquired machinery for 40 million naira in year 1. Due to inflation, its replacement cost rose to 55 million in year 2. The company sold products worth 60 million naira in year 2. Assuming there are no expenditure required, if a company applies physical capital maintenance, has it made profit?
We didn't get the question, sir.
It's on the screen.
Okay.
Yes.
Thank you.
Let's read it again. Assuming, a company acquired machinery for 40 million in year 1, but due to inflation, the current cost is 55 million in year 2. The company sold products worth 60 million in year 2. Assume there are no expenditure. If the company applied physical capital maintenance, has it made a profit?
Yes.
Yes, sir. Yeah,
yes.
So how do you determine the profit?
Because the company acquired, the first acquired, when we bought it in year 1, it 40 million. But due to inflation, it rose to 55 million naira in the year 2. Okay. So when we less this 40 million and the 55, we get 15 million naira there. And at the end of the year, at the end of the year 2, and you see now 600 million in year 2. So
sir,
if you less
question, sir.
Okay, please don't hold on. Okay, go ahead. Go ahead, please.
Yes, sir.
Yes.
Sir, is there no depreciation?
No, there's no depreciation.
Is there no depreciation, sir?
No, there's no depreciation. There's no depreciation.
Let's not waste time. Just hold on. Let's not waste time. Just hold on. Number 1, you must always know what is your capital. It is very, very important. What are the constituents of your capital? You see, the constituents of your capital are, your net assets. In other words, it is, it is what we call in your, let me just take you back to balance sheet now. In your balance sheet, we always tell you that apologies, please. The network is coming up. So, okay, this is how this is where we are going to end the class. It's as simple as that. We'll look at it some other time. But please, before I conclude, let me take you back to your balance sheet. Your balance sheet talks about assets and equity and liability. In other words, your asset will always be equal to your equity and liability. So whenever you have what we call the net asset, it will always be equal to your equity and liability. That's what we call a balance sheet. In other words, the total asset must be equal to your total equity and liability. So depending on the kind of question that they give to you, if they only give you total asset for the year, please, just total asset will be equal to your capital. If they give you equity and liability, know that that will be your capital. So in this question, the first thing that you need to determine, or the first that you need to know, is that sorry, apologies, please. The first that you need to know is, sorry, I want you to see the question. That you need to know is this: what is the capital for the current year? That is the first. But in year one, they say they bought the asset for 40 million. That is historical cost. Meaning that we close year one with 40 million. But at now, we are closing year one with 55 million. Is that also? 55 million. Meaning that the current cost or the current capital is 55 million. In other words, this 40 million is historical cost, whereas this 55 million is the current cost of this machinery, and that is an asset, and the total put together is now 55 million. So for you to determine your profit, it will now be, what they said, the company sold product worth 60 million, meaning that the total income or the revenue, as it were, is 60 million, assuming there are no expenditure. In other words, the profit that you are supposed to make for the year is 60 million. But due to the concept of capital and capital maintenance, you know that your income and your expenditure will give you your profit. But due to the concept of capital and capital maintenance, it means that at the end of the year, 55 million is your capital that you must maintain. So 55 minus 60 will give us the profit. That is how simple it is. So please understand this small basic. The revenue is 60, the 55 million, profit is this. So 55 million is only recognized as profit because of the cost. The capital as must first be preserved. That is that for that. So we see in our next lecture, and where I believe we'll look at all of everything together again, and then we'll have a nice time. Thank you so much for your time. I do wish that you have been able to get something in this question. Please leave your questions in the comment section. We will deal with them. Thank you so much.